Welcome, everyone. We have another great video. We're talking about worries in retirement.
Yes,
A couple of tips so you can worry less and build a more durable financial plan.
That's the big one.
The whole idea here is if there's something that keeps you up at night in the financial, what you're worried about, well, likely there's a way you can test that as part of your plan to make you feel a little more at ease. We're going to cover a few of the common ones, and one we run into frequently when we do financial planning with clients is, what if my spouse passes away?
Yeah, that's a really big one because inevitably, if you're married, one is going to usually pass before the other one does. So this is going to play into your financial plan no matter how you look at it. So it could have a big impact on a variety of things. You could get less pension, whether it's CPP or a private pension. You can't split the income anymore. That's a big one because there's no party to split it with. And now it's all on one tax return, and that can have a very big scenario. But the big factor is you can stress test for all of this stuff in your financial plan. That can give you a little bit more of that peace of mind and ease that you're looking for.
Yeah, and we do exactly this for our clientele. So, all right, one spouse passes away at this time. What does that look like for all the other variables? What if it was this time? You can do a couple of options there.
That's right.
We are a robust plan, one that'll make sense in all the different scenarios.
Exactly.
The reason we do that is because, like you mentioned, CPP, there'll be a survivor component for your spouse, but likely it'll go down. OAS just disappears. Gone. You don't get any.
Nope.
There's no survival component, old age security. And then it's all in one tax return. You can't split. Changes the tax planning. So it is a more difficult situation. Another one we run into frequently is really a worry of running out of money.
Yeah.
Do I have enough? Am I going to run out? Often this is for folks early in retirement, people that are well into retirement, no longer worried. They've kind of lived through that. But early retirement, a very common concern. Do I have enough? Well, there is a tip that we use to help solve it.
Yeah, I mean, normally you want to look at that lifespan. Now, nobody knows how long they're going to live, but you want to make that projection, right? I mean, if the average age of male is 84, or if a female is 87, we tend to take a look at that 94 to 96 range. Because if you project further out and that is sufficient for you, then you're okay if you pass away in a shorter period of time. So using numbers that are way out that basis, that's going to give you a little more confidence that, hey, fine, if I can make it to 95, I'm still good. That's a big factor. And if we take a look at the chart here, how long Canadians live, you'll see that there's a variety of different options we've seen there.
Yeah, we're doing this based on a little bit of data. That's
exactly
the whole crux of the living longer, because there's two pieces here. One is the worry. Do I have enough? Using a longer age in your plan can help find some peace of mind there. The other is folks often use too short of a time frame. The opposite problem.
Yep.
And that's what this table is geared to help solve. It's Statistics Canada, so it's specific to Canadians, and they have life expectancy based on your current age. So if you're currently 65, so you're a healthy 65-year-old, well, if you're a man, you're 16.7 years in addition of life expectancy. That's nice. On average, you're living to 81, 82. And for women, it's even longer. You're talking 21 years, 85, 86. Of course, these are averages. It's not specific to one individual, but across the population of retired Canadians, it means you're probably going to be in retirement for a few decades.
Yes.
That's a common idea. And then going back to our first point, if you're worried about running out of money, you add a few extra years to that when you do your plan.
That's right.
Just to make sure you're on solid footing. Another common item, and I get why this is a common fear.
It is.
Especially recently, we've been through a bout of high inflation. But it's fear that inflation is really just going to erode all of your capital.
Well, exactly. And inflation is a huge factor to go with. I mean, nobody really plans it. I mean, I want to make $50,000 a year is what I'm looking at going forward. Well, $50,000 today, 15 years from now, that's not $50,000. Inflation is out there no matter what, and it's going to increase your prices. So traditionally, we've always used that sort of 2%. That's the government of Canada, the Fed. Most places in global societies around the world use that sort of 2% target of inflation. But what if inflation is like it's been over the last few years and it gets up there? Now you're averaging, say, 3. We've got to figure out how much more of my capital is getting eroded. So by doing that, we like to throw that in as a projection as well, maybe 2.5 or 3%. Now you'll see what the numbers are. So, I mean, if we take a look at, 15 years down the road at 3%, well, that 50,000 that we're using as an example, you're now almost 78,000 you're going to need. And of course, if you're using 3.5 on 25, well, you're more than double. 118, almost $120,000 is going to be needed 25 years down the road to be able to capable that same spending limit that you had at 50 today.
Yeah, so the table there just kind of shows the idea of how inflation compounds. So like you said, 3.5%, if that's the inflation rate, 25 years from now, they have 50,000 in today's terms of spending money. You need like 118,000. So how do you handle that in a potential plan? Well, so I'll just run my plan at 4%. Well, you probably don't need to do that. You can keep maybe a 2.5% as your assumption, but then there are factors you can stress test. Say, all right, what if we're wrong? We'll do our base case plan, but then we'll do another plan. So what if instead of 2.5, it's really a 3.5? what does it look like for the estate? How much money is left over? What does it look like from the tax scenario, from the spending? If you can do that kind of projection, that kind of stress test on a financial plan, and that's how we kind of handle the worry about inflation. We can show you some of that data.
Yep.
And this is all coming from questions we received from folks through our website. So if you have a question or if you want kind of an answer to something you're thinking about, how do people get a hold of us?
You go to chatwithclintonandkevin.com. By all means, get there. If you have more answers on durability of your plan or any other financial questions, please send them to us. They come right direct to Clinton and myself. Nobody else is answering them. No robo technicians are there. And we're more than happy to get back to you as quickly as we can and help you out with your financial situation. Also, we have a new thing on our website that you can deal with, and that is
a newsletter. If you're liking these videos, you'll probably like the newsletter. Similar concept where we pass on little tips and tricks when it comes to the financial world. Also, we do webinars on occasion, a couple of them per year, and that's where we send the invites. They're free to sign up.
Yep.
If you're liking the video, go to becker.com. You can sign up for the newsletter as well. One more area where often it's a cause for concern and how we can kind of navigate that with a more durable plan is rates of return.
Yeah, and rates of return are a big one. I mean, theoretically, if you take a look at this year, most plans that were even on a balanced portfolio were in that double digit. But you cannot forecast the double-digit return every year. Typically, you're sort of using that 5 to 8% range. You'd like to be able to on a balanced sort of scenario, more conservative, a little less, more aggressive, a little more. But we like to use that sort of 4 and 5% range. Let's go with a low end. Let's be cautious. Let's be conservative to make sure. And remember, most of the tips we're giving you here are worst-case scenarios. If you can survive the worst-case scenario, things are going to go better. But yeah, in particular on returns, use that 4 to 5%. If you're getting more, that's always a better idea. But if we use that projection, that's going to give you that safe, secure peace of mind that you're looking for.
Yeah, the idea is what is it you're worried about? And then can you structure a plan to help specifically navigate that scenario? So if you're worried about rates of return, we'll use a lower number. Say, all right, my plan's fine with 3%.
Oh, exactly.
Great. I can just peace of mind. If you get more than 3%, great, you have surplus, or maybe you just put it all in GICs and don't worry about it.
That's right.
Because you can get your guaranteed return that way. Another common area, still in the bucket of rate of returns here, is market volatility, specifically market crash. Now, later retirement, usually it's still not fun, but less of an impact. Often, if there's a market crash early in retirement, that's where it could be more significant, especially if you're doing withdrawals. So we can test for that specific scenario. We can put a base case plan and then do a stress test. Say, all right, what if there was a big market event in the first year or two of retirement? How would that throw our numbers off? Because we're assuming a nice average, but if you get a big drop, that's not as it is average, not most volatile. And we do that for all of our clientele as part of our base planning. It can help alleviate that fear as well, knowing, okay, if there is a big market event, my plan's still going to be all right. So you can stress test those type of scenarios to give you a little bit of peace of mind. A few concluding thoughts here. Don't go overboard with the planning. You don't want to test 17 different variables and somehow you got an airtight plan here. It's not how it works. The concept here is you have 1 or 2 things that really keep you up at night. You can probably plan for those items, but the plan is meant to be organic.
And again, this is the key reason for having a financial plan. If you don't, you're running through life going, say, this looks good, I've gotten these returns, this is going to last forever. Well, you know what? You want to make sure of it. And the way to make sure of it is to stress test some of these things, as you said, not everything, a couple of them here and there, and to make sure you have a financial plan. Having that financial plan is the key piece to everything going forward, and it helps with your goals, your risk, and everything else. And we're always encouraging that. That's our mantra, is have a plan, and then these things will make it a lot easier for you to deal with sleeping at night.
That's the idea. If you like this video, there's another one floating on the screen, 4 retirement mistakes to avoid. Click on that guy. We'll see you again very soon.
Take care.